This is something that you write a lot about. You've written in recent months a lot about the housing woes that the U.S. market still faces, and you are way ahead of the curve, ahead of the housing bust, too, to go back a few years. Now, there is some news today, some data that housing starts unexpectedly fell in July, groundbreaking on U.S. homes. New ones unexpectedly fell in July. That's according to the Wall Street Journal. They say unexpectedly and say this is a reminder of the housing market's weakness, despite some recent signs of recovery. I doubt this would be unexpected for you, as you've been talking about problems with the housing market for a while. Before we get into the details, we'll get into those, what are other people missing that you're seeing?
I think it's a combination. There's a lot of wishful thinking from a lot of people out there. There's another group of people who've been calling the housing bottom every year since 2005. And I guess if they call it every year for the next 10 years, eventually they'll be right. We posted something on the big picture a few weeks ago that basically went back over the past 6 years and just reproduced every housing bottom call from everybody from Mark Zandi, who's been horrifically wrong about this, maybe the single worst economist when it comes to housing, to the National Association of Realtors, to the Wall Street Journal. A lot of people with vested interest in housing who are not objective have been just clamoring, calling, begging, wishing, praying for a bottom, and they've just been wrong for the whole housing collapse. Look, when we went through a period of time when we abdicated lending standards, where if you can fog a mirror, you got a $500,000 loan. My favorite example was the two people in California who were strawberry pickers making $14,000 a year, got approved for a $750,000 mortgage.
Oh, man.
If they took 100% of their pre-tax income and gave it to the bank, they still would have defaulted. Yeah. That was what allowed us to develop this giant bubble, this credit bubble, this housing boom and bust. And now it's the other side of it. Now you're working out all of those housing busts. You have a lot of marginal homeowners who are underwater, who are behind in their payments. We probably have somewhere between 3 and 6 million more foreclosures to go. Until you clear that out, you just can't even talk about any sort of recovery. By the way, if you've been paying attention to the usual suspects, first we had a housing turnaround. Things are getting better, it looks great, and then that became a housing bottom, and now what we're hearing about is the housing stabilization.
Right.
If you look at the drivers of housing, none of the building blocks are in place for a full-fledged recovery. Okay,
perfect. So let's set aside all that wishful thinking and talk about the nuts and bolts that you see, the foundation that you're talking about right here. Let's start with supply. I thought it was interesting. Another Wall Street Journal was talking about the recent Case-Shiller data, the last round that we got, saying that there were broad housing gains across the nation versus prior months, and still down a little bit year over year, but much better than from the prior year before that. And they said, hey, if this continues, this should go on through summer because supply is low. Now, I would imagine from what you've written about shadow inventory that you would disagree with this assumption. So fill us in on how shadow inventory or ghost inventory is haunting the housing market stabilization.
Sure. So you have a couple of factors in place. First, part of the reason inventory is low is if you're underwater in a house $200,000, you can't sell that house without the bank's permission, and good luck getting the banks to give you permission to do anything. They're just completely a mess. The left hand doesn't know what the right hand's doing. So getting any cooperation from the major loan servicers, from the major money center banks, they're just internal disasters. They can't really figure out what's going on. So there are lots of people, there are lots of supply that would be on the market, except for the fact that the last number I saw was about 24% of the homes that have mortgages. And that's about 70% of the total supply of owner-occupied homes. I think the most recent data is about 90 million homes are owned by people. Figure about a third of those homes don't have a mortgage, so you back that out. But you still end up with somewhere between 12 and 16 million homes that are significantly underwater. So that's a potential supply that as soon as they're capable of selling the home, they would, but they can't because they're buried in it. They can't write a check for $100,000 or $200,000 to the bank to allow them to sell. There are all sorts of problems with this. It reduces social mobility. If there's a job over there, you can't take it because you're stuck over here. That leads to walkaways. It leads to other issues. So that's the first group of homeowners, titular homeowners, the people who are underwater 5, 10, 15, 20%. The data, by the way, shows that when you're underwater 25%, the people who walk away then spike up because you just can't imagine ever getting out. Look, if you own a home, the home is worth 5 or 10% less than your mortgage. Hey, you got to live somewhere. Eventually, home prices will come back, and you'll be able to get out of the house.
Right.
If you want to trade up, if you want to move, if you want to take a job, that's where that's a little bit of an issue because you literally have to write a check to get out of the house. The next group of ghost supply that's out there, you know, during the boom, the National Association of Realtors reported the number of homes that were second homes, vacation properties, investment properties. And the reality was you don't just get a surge of people buying vacation property. It was a lot of people who just wanted to jump on board the housing express and flip it to, you know, the greater fool behind them. The reality is that even the people who aren't underwater or can afford to service those mortgages, they would love to see higher prices in order to put that burden back on the market, get out from under it. So that's the next level of housing, that supply that's out there. That's before we even talk about all the REOs, the bank-owned real estate owned REOs, that the banks have kind of been kicking the can down the road. They've been reluctant to foreclose because they know what happens with the house, with the other properties in the neighborhood. Typically, distressed sales are 20 to 30% below identical non-distressed sales. So not only are you taking the write-down, but if you have mortgages in the immediate vicinity, now you have a comparable. When they go to do appraisals, it's bad. It's going to be problematic. The last group of, let's call them ghost supply, according to Lori Goodman over at Amherst Securities, there are 2.8 million homeowners who haven't made a payment in 12 months or more. You have to figure they're so upside down, they'll never be able to modify those. The odds are that the vast majority of these, and I would guess 90+% of those 2.8 million, are either going to be short sales or foreclosures or distressed sales of some type. And that's out there, and it's waiting to come on market. You know, we've been hearing through various individuals, and this is admittedly anecdotal evidence, that banks have been saying, look, just mow the lawn, shovel the snow, don't destroy the house, pay the taxes, and we'll let you live there another year. And so that's yet more supply that's out there, where these, let's call it strategic non-foreclosures by the banks. I'm assuming that that's coming to the end of its natural life. And finally, the last piece is, we had this big robo-signing scandal. The banks got off with a slap on the wrist. They got lucky. During the negotiations, they voluntarily agreed to stop foreclosures until they cut a deal. And for 13 or 14 months, they agreed to this foreclosure abatement. They signed the deal back in January, February. It takes a few months to crank up the foreclosure machinery, and those foreclosures are going to start coming online in the fall. That's going to pressure prices. That's going to pressure units. It's going to be back to where we were a year or two ago, despite the massive efforts the Federal Reserve has put into driving mortgage rates down. I think rates are now 150 basis points below where they were 2 years ago. That's roughly the equivalent of 17% more buying power, rates down that low.
With modifications and tax credits, and you mentioned how things have been propped up by the Fed. Has this been helping to stabilize the housing market, or has this been prolonging the much-needed bottom so that we can see a real recovery in housing?
My thesis for a long time has been you're better off to just tear the Band-Aid off quickly. It's more painful, but it's a short, sharp drop, and you get it over with, instead of this death by 1,000 cuts. It's not so much that they've been propping the housing market up as they've been making the slope of housing a little more gentle. We still haven't gotten to the point where home prices are really, really cheap. Look, if the Fed and the government are successful in what they're trying to do, this will be the first time an asset bubble has been wildly overvalued and then merely reverted back to fair value. Historically, when you get a boom, think about the dot-coms, think about the home builders, the banks, the investment firms. When they bust, they tend to careen wildly below fair value until they get really cheap. Homes are back to where they were in 03, 04. Based on a number of factors, they're probably at fair value. But I would imagine, given how stupid things got to the upside, the symmetry that the markets usually exact is stupid to the downside. And that just hasn't happened.
And we haven't seen that. And I know you wrote in April that you could still see home prices coming down 10%. Is that still what you think? 10% down from here?
10% is if we don't have a major recession, just allowing all these foreclosures that have been abated, temporarily put on hold. Now that that hold is lifted, another 5 to 10% you could do standing on your head. If we get a significant recession, and there's always a recession somewhere off in the future, but if the recession comes sooner rather than later, ultimately you could see an uptick in unemployment, an uptick in the number of people who have mortgages that rely on their income to pay those mortgages. Ultimately, it's more defaults, more foreclosures, lower prices, if that happens. But 5 to 10%, that's easy. Anything beyond that requires a deeper recession to drive mortgage payers out of that area because they lack the income to make their payments.
Right. And then on the demand side, although mortgage rates are incredibly low, they're at lows compared to recent years and decades even. Who can qualify for those on the demand side? You mentioned how many people are underwater on their homes. This isn't factoring in households that are credit impaired and can't even qualify. Not to mention, in a period when people are deleveraging and consumers have been up to their eyeballs in debt, who can afford tens of thousands of dollars for a down payment? And with flat wages and a high unemployment rate, who can pay for the monthly payment?
It's someone who has a good income, a good credit history, not a lot of debt, has a good loan-to-value ratio of the home, someone who hasn't missed too many payments over the past 3 years, somebody who didn't fall behind on their previous mortgage. It's an increasingly narrow pool. And then add to that, you just look at the MBA, the Mortgage Bankers Association. The number of applications has been in a steady move down despite the record low rates. Because at this point, you know, about 2 months ago, my comment in public was, if you have a home with a mortgage, you should be refinancing because there's a lot more upside to rates than there is downside. And I stand by that. If you haven't refinanced now, do it soon, because if you don't, you're going to ultimately see rates go up eventually. But right now, they're at record low levels. Look, you could do a 15-year mortgage at 275. You could do a 30-year at 3.875. Under 4% is a ridiculous number for a 30-year fixed. And I suspect we'll be talking about this 5 and 10 years hence. Remember when mortgage rates were 4%? How ridiculous was that?
Right, yeah, I know. And it's just crazy how many people still can't qualify for that, given the situation that we're in. And I'm just curious, despite the fact, too, that housing prices are at lows we haven't seen since, what, 2003? Given that, along with the low rates, still, though, are houses really affordable to most people, given the circumstances?
The other thing is, that's right. That's what people forget. The National Association of Realtors puts out this index called the Home Affordability Index. To give you an idea of the value of this, from 2000 to 2006, there was 1 month when they said homes weren't affordable. I mean, it's completely worthless sort of index. But it's also thinking about it backwards. Homes don't get sold randomly. People buy homes. And the question is, do you have the credit rating? Do you have the mortgage approval? Do you have the down payment? 20% down payment is a big chunk for a lot of people, especially people who got killed in the stock market in 2000, who may have extended themselves for a second home, who got killed in the stock market in 08, 09. A lot of people just don't have that 20% down payment, or the income history, or the wage gains, or the FICO score. So the amount of people who can actually go out and buy these affordable homes, I just think it's a really, really misleading thing to say homes are affordable, and you know, it's true. A lot of Chinese people are buying homes on the West Coast, San Francisco, Vancouver, Miami also. A lot of Europeans are buying homes in New York and Florida. So yes, these houses, these units are affordable to people. Unfortunately, they're not Americans who live here. That's the bulk of the buyers of homes.
Right, which a post on your blog today talks about that, how investors and first-time buyers are not the drivers of the housing market or primary demand. It's repeat buyers. So it's interesting. It sounds like we have a really long way to go. Before we go, Barry Ritholtz, I want to ask you, because from what I hear, you are a pretty no-nonsense guy. And so I want to get your no-nonsense response to this. And I'm not judging you. I'm just saying what I've heard. Maybe it's right, maybe it's wrong. But given that, I want to know your response on this report that's come out that the New York Times Deal Book says that MF Global executives aren't likely to face criminal charges, that's what they're hearing from their sources. Right. Despite everything we've seen, the customer money that's still missing, that some would say has been stolen, no charges for execs. What's your reaction to that, if that is true?
So the two issues people keep talking about, is this because of John Corzine is politically connected, and how can there be nobody found any sort of guilty? And they're two different things. First, by definition, if $1.8 billion of customers' money disappears, a crime has been committed. The technical legal term of taking customer cash and hypothecating it through London and leveraging it up 15 to 1, and then buying sovereign debt, you know, it may or may not be within the technical legalities of the law. But when you read the rules that govern borrowing client cash, it's to be put into safe investments. And, you know, buying Greek and Spanish debt, that's not like buying U.S. Treasuries. That's not a safe investment. And the fact, by definition, it's not a safe investment because it lost $1 billion+. I think someone has to be found accountable, just like the robo-signers, someone has to be found accountable. Now, whether or not the guy at the head of the company knew about it, or should have known about it, or who's only been there a year and how long has this been going on, you know, that's a much tougher thing to prove. You have to say, this executive knew that this was going on, and here's the comments, and here's the emails, and here's his signature on that. That's from a prosecutor's standpoint, that's a little more difficult to prosecute. But look, one of these son of a okayed the moving of money from client accounts to buy Spanish debt. That's the guy who has to go to jail. Look, I don't think Jamie Dimon said, I have an idea. In order to prosecute all these mortgages, all these foreclosures, go hire a bunch of burger flippers from McDonald's, offer them $1 more an hour, and have them do 100 of these an hour, even though it takes 2 hours to do a foreclosure. I'm pretty confident that wasn't Jamie Dimon. But I'm also pretty confident it wasn't the burger flippers. Somewhere in the middle, some jackass said, let's just ignore 3 centuries of property law and just crank this through. Yeah. That guy should go to jail, just like the guy from MF Global. The problem is, we're governed by a White House and a Congress that's in bed with the banksters, that the prosecutors lack the spine to say, let's do what we did after the S&L crisis. Let's grab 1,000 of these son of a bitches and put them in jail, and maybe that'll send a warning that'll last 30 years, because that's what happened after the S&L crisis. It took a full generation to pass through banking, and forget that people go to jail for stealing. I know it's a crazy concept, but that's what's supposed to happen. It's a deterrent effect that'll last a decade or two, and that's what we should be doing now.